In 2024, industrial demand for silver climbed to nearly 680 million ounces, setting an all-time record and marking what appears to be the fourth straight year of historically high consumption. Now here's where the story starts to get truly compelling. Global silver mines are estimated to have produced roughly 820 million ounces in total during that same year. When you put those two numbers side by side, it reveals a supply shortfall of close to 150 million ounces. According to industry analysts, this isn't a one-off event either. This pattern has now repeated itself for 5 consecutive years. Since 2021 alone, market observers estimate that approximately 820 million ounces of above-ground silver stockpiles have been drawn down. Let that sink in for a moment. That's essentially the equivalent of an entire year of global silver production quietly disappearing from available supply. Today, I want to walk you through exactly why this tightening supply situation could fundamentally reshape the silver market in 2025 and the years beyond, and why silver recently touched levels that analysts are calling an all-time high, trading above $60 per ounce. If you find value in deep dive market analysis like this, make sure you subscribe now because this channel focuses on critical commodity trends that many financial outlets either overlook or barely mention. And while you're here, drop a comment below with your silver price prediction for 2026. I read every single one, and the range of opinions is always fascinating. Now let's break down where all this silver is actually going, because the demand story today looks nothing like it did just 5 years ago. The biggest shift starts with solar energy. In 2024, photovoltaic applications are estimated to have consumed roughly 195 to 200 million ounces of silver. To put that into perspective, nearly 1/4 of all global mine production was absorbed by solar panels alone. China, in particular, has been driving this surge. Reports indicate that in 2024, the country installed a staggering 600 gigawatts of solar capacity. Fast forward to the first 10 months of 2025, and industry insiders reveal an additional 250 gigawatts have been added. Each gigawatt, it's estimated to need around 300,000 ounces of silver. That's a whole lot of shiny metal. But here's the twist: despite silver prices hitting record highs, solar demand for 2025 is still projected to be robust, with analysts forecasting around 195 million ounces. So, what's keeping demand afloat? The answer is straightforward. Global solar installations are ramping up faster than manufacturers can trim the silver content in each panel. Sure, efficiency improvements are underway, but the pace of deployment is outstripping those gains. And let's not forget electric vehicles EVs, another major player in this silver saga. A gas-powered car usually requires about 15 to 25 grams of silver, while an electric vehicle needs between 25 to 50 grams. That's nearly 79% more silver per EV. In 2024 alone, electric vehicles are estimated to have accounted for about 25 million ounces of silver demand. And the momentum isn't slowing down. EV production is reportedly growing at an annual rate of around 13%. By 2027, some analysts predict that electric vehicles could eclipse traditional cars as the top source of automotive silver demand. Now, just a quick note: I'm not a financial advisor, and this isn't financial advice. I'm not linked to any companies or organizations mentioned here, just sharing some educational insights based on publicly available data. But when you connect these dots, it sparks a compelling question about the future of silver prices. Something to ponder. What we may be witnessing right now is a structural shift unfolding in real time. The third major demand driver is data centers and AI infrastructure. Global data center power capacity has reportedly expanded by more than 5,000% since the year 2000. Every AI server, every 5G tower, every cloud computing facility depends on silver for electrical contacts and high-efficiency connectivity. This is the quiet demand engine that rarely makes headlines, yet it plays a critical role behind the scenes. As artificial intelligence continues to scale across industries, silver demand tied to technology infrastructure appears to be accelerating rapidly. These are not short-term trends or temporary cycles. These are decade-long build-outs reinforced by government policy, national security priorities, and the global energy transition. Before we go any deeper, make sure you're subscribed because next week I'm breaking down the AI infrastructure silver story in much more detail. It's one of the most overlooked forces in the market right now, and you won't want to miss that discussion. But here's where the situation becomes even more compelling. Despite demand hitting record levels across multiple sectors, silver production appears to be barely responding at all. And to understand why that matters, we need to take a closer look at the supply side. Let's talk about silver production. This is where the story becomes especially intriguing. Global silver mine output in 2024 is estimated at around 820 million ounces. Looking ahead to 2025, industry watchers suggest production may rise to roughly 835 million ounces. That's only about a 2% increase year over year. At first glance, that might not sound alarming, but context is everything. Industrial demand alone is estimated at around 680 million ounces. That means roughly 81% of total mine production is already being consumed by industry before we even factor in jewelry, investment demand, or silverware. When you start adding those categories back in, the supply math quickly becomes uncomfortable. Here's the part that really stands out. Even with silver recently trading above $64 per ounce, a level many analysts are calling an all-time high, production still appears largely unresponsive. In most commodity markets, higher prices tend to bring new supply online. But silver doesn't seem to follow that script. And there's a very specific reason for that. What most people don't realize is that roughly 70 to 80% of silver production comes as a byproduct of mining other metals, primarily copper, lead, zinc, and gold. Think of it this way. Imagine you own a bakery that sells bread, and every loaf of bread comes with a free cookie. You can't just decide to make more cookies because cookie prices suddenly went up. You can only produce more cookies if you bake more bread. That's essentially how silver production works. Miners aren't primarily mining for silver. They're mining for copper or zinc, and silver simply comes along for the ride. This means silver supply is fundamentally tied to the economics of base metals. If copper demand slows, silver production can actually decline even if silver prices are soaring. In other words, silver miners can't easily ramp up output just because silver looks expensive. That structural constraint is one of the most misunderstood aspects of the market. If you're finding this breakdown useful, hit the like button. It really does help the algorithm share this analysis with more people who want to understand what's happening beneath the surface of the silver market. And to be honest, YouTube's algorithm has been especially tough lately, so every like genuinely makes a difference. Now consider this final point on supply. Opening a new silver mine reportedly takes anywhere from 10 to 15 years, from initial discovery to actual production. It requires hundreds of millions of dollars in capital, along with years of environmental studies, permitting processes, and community agreements. Even if miners launched major new projects today, which many are not, we likely wouldn't see meaningful new silver supply until sometime between 2035 and 2040. When you put all of this together, it starts to clarify just how constrained silver supply may be in the years ahead. Let me give you some concrete examples to put this into perspective. Mexico, reportedly the world's largest silver producer, mined roughly 185 million ounces in 2024, but that only represents about a 2% increase over 2023. Peru, the third largest producer, actually saw a decline of around 1%, and Chile's production reportedly fell by approximately 17% in 2024. Looking ahead, Australia is forecast to potentially decline by 12% in 2025. When you add it all up, the top three countries, Mexico, China, and Peru, are estimated to produce around 400 million ounces combined. That's nearly half of global silver supply concentrated in just three nations. Any labor strike, regulatory change, or geopolitical tension in these regions could immediately ripple through global markets. Now, here's a part that should really catch your attention: declining ore grades. The easy-to-mine silver is mostly gone. Today, miners are processing ore that is estimated to contain 30 to 40% less silver than it did a decade ago. That means they're putting in significantly more work for roughly the same output. At this point, you might be asking, if there's a deficit every year, where is all this silver actually coming from? That's exactly the right question, and the answer is crucial. Let's break down the numbers. In 2024, total silver supply is estimated at about 1 billion ounces, roughly 820 million from mines and 190 million from recycling. Total demand, analysts suggest, was around 1.6 billion ounces. That implies a deficit of nearly 149 million ounces. Where did that 149 million ounces come from? From above-ground stockpile silver sitting in vaults, ETFs, industrial warehouses, and strategic reserves. Since 2021, we've reportedly experienced 5 consecutive years of deficits totaling around 820 million ounces. Let me repeat that for emphasis: roughly 820 million ounces. That's almost an entire year of global mine production drawn down from stockpiles. Even more concerning, inventories at major trading hubs are starting to show real stress. The Shanghai Futures Exchange is reportedly at multi-year lows. London silver vaults are showing rising lease rates, indicating potential delivery pressure, and warehouse drawdowns appear consistent. Analysts estimate that visible above-ground inventories have dropped from about 1.5 billion ounces in 2020 to under 1 billion ounces today. At current deficit rates, we may have only about 4 to 5 years of buffer remaining. So, drop a comment right now. Do you think we'll see a supply squeeze in the next 2 to 3 years? I really want to hear your thoughts on this. Here's what's critical to understand. These deficits are happening even with relatively low investment demand compared to historical spikes. Back in 2010 to 2011, when silver rallied from around $17 to $49 per ounce, investment demand reportedly surged from roughly 50 million ounces to 250 million ounces in just 18 months. If a similar pattern were to happen today, and with the Federal Reserve potentially entering a rate-cutting cycle, which historically drives precious metal investment flows, where would an additional 100 to 200 million ounces come from? The reality is, it likely wouldn't come from mine production. It wouldn't come from recycling. It would have to come from depleting stockpiles even faster. To give you some historical context, on December 12, 2020, silver reportedly hit around $65 per ounce, surpassing what many analysts consider the inflation-adjusted peak from 1980. Today, silver is trading in the low $60s range. But here's what really matters. This isn't speculative mania driving prices. This appears to be a fundamental supply-demand imbalance. Major financial institutions are taking notice. Bank of America recently raised its 12-month silver target to around $65 per ounce, while it expects silver to average roughly $55 into 2026. Some analysts are even discussing $100 plus scenarios if investment demand fully returns. Finally, consider the gold-silver ratio. It's compressed to somewhere between 67 and 69, reportedly the lowest level since the summer of 2021. Historically, when this ratio compresses, it often signals that silver is catching up to gold's performance, and that could have major implications for both investors and industrial users alike.
If the gold-silver ratio drifts back toward its long-term average of 50-60, silver could outperform gold in a big way. Make sure you're subscribed, because next month I'm dropping a full deep dive video on the gold-silver ratio, what it's signaling for the next 12 months, and why it could be a game changer for anyone invested in precious metals right now. Trust me, You don't want to miss this. Now, here's why 2025 could be unlike any year we've ever seen for silver. 5 major catalysts are converging, creating what looks like a perfect storm. Looking ahead to 2025 and 2026, these factors line up in a way that's unprecedented, and each one has the potential to dramatically impact silver's supply, demand, and price. Factor 1. China's solar boom is showing no signs of slowing. In fact, reports suggest China is on track for more than 250 gigawatts of new solar installations this year alone. That's roughly 75 million ounces of silver demand from a single sector in a single country in just 1 year. China has already surpassed its 14th five-year plan targets and exceeded provincial goals, with a long-term ambition of 3.6 terawatts of combined wind and solar capacity by 2035. This is demand driven by policy, not price. Whether silver trades at $60 or $80 an ounce, these projects are moving full steam ahead.
Factor 2. Critical mineral designation. In 2025, the United States officially designated silver as a critical mineral. This move could change the game entirely. It suggests potential strategic stockpiling, prioritization of domestic supply chains, and a broader recognition of silver as not just a precious metal but as a strategic material essential to national security. When governments begin competing with industrial users for silver, demand dynamics could shift dramatically and permanently. Factor 3. The Federal Reserve rate cutting cycle. Historically, lower real interest rates have triggered substantial flows into precious metals. We've seen this in 2010-2011 and again in 2020. With the Fed now cutting rates and real yields compressing, conditions are increasingly favorable for investment demand to return. Keep in mind that current deficits exist even with relatively weak investment demand. If even 20% of the investment flows seen in 2011 were to return, we could see an additional 40 to 50 million ounces of silver entering a market already structurally constrained. Let me ask you, are you currently positioned in silver? Physical holdings, ETFs, mining stocks? Drop a comment. I love seeing how this community is thinking about this opportunity. Factor 4. Dollar diversification trends. Central banks around the world are increasingly diversifying their reserves away from dollar-dominated assets. This shift could strengthen demand for tangible and strategic metals like silver, particularly in times of geopolitical uncertainty or financial market volatility. These first 4 factors alone paint a compelling picture. But there's a 5th catalyst that may truly accelerate silver's trajectory, and we'll explore that next. Gold often grabs the headlines. Silver is increasingly being viewed as a monetary metal light, especially by countries that can't afford massive gold purchases. Reports suggest that India, China, and several Middle Eastern nations are quietly accumulating silver for strategic reserves. Factor 5. Physical market tightness. This is the one that should concern market participants the most. Rising lease rates in London indicate that borrowing costs for physical silver are climbing, which is often a signal of delivery stress. When lease rates rise, inventories deplete, and prices hit all-time highs simultaneously, the market may be sending a clear distress signal. These are not speculative hypotheticals. These are real policies, data trends, and market signals that are already in motion. So, where does all of this leave us? Let's put it all together. For what appears to be the 5th consecutive year, the silver market is experiencing a structural supply deficit. Unlike previous commodity cycles, this one seems to be driven by permanent, fundamental demand, largely from the global energy transition, not speculation. Bank of America has projected silver at roughly $65 per ounce over the next 12 months, while it expects an average near $55 into 2026. Some analysts are even discussing $100 plus scenarios if investment demand returns to even a fraction of 2011 levels. But here's what really matters. This isn't just about hitting a specific price target. This is about recognizing that the supply-demand fundamentals appear to have shifted permanently. Silver is no longer just a precious metal, it's increasingly an industrial commodity critical to solar energy, electric vehicles, 5G networks, AI infrastructure, and even national security. At current production levels, there simply doesn't appear to be enough silver to satisfy both industrial and investment demand.
For investors, this could represent a multi-year structural opportunity, not a short-term trade, but a fundamental reallocation based on physical scarcity. The bigger question isn't whether silver will go higher. It's what might happen when above-ground stockpiles are exhausted and the market faces annual deficits of 100+ million ounces with no real supply response. If you haven't already, smash that subscribe button and turn on notifications. Over the next few months, I'll be covering the entire critical minerals complex: lithium, cobalt, rare earths, and how these same supply constraints are shaping the silver market. Drop your biggest takeaway from this video in the comments. What surprised you most? The 820 million ounce deficit, the byproduct production problem, China's massive solar build-out? I want to hear what clicked for you. I'm also curious, do you think investment demand will return in force in 2025 to 2026, or could industrial demand alone push this market toward 100+ per ounce? Share your thoughts below. Thanks for watching. If you want a deeper understanding of why silver's byproduct nature makes it fundamentally different from every other commodity, I covered that in detail in my last video. I'll link it in the description. And if you've made it this far, you're exactly the kind of serious investor I make these videos for. I appreciate you being here, and I'll see you in the next one.